These are 7 small cap stocks that are ready to take off now that the Federal Reserve started the rate cut cycle, and these are crucial to own in your portfolio. The first stock is Redwire, and this company is an unstoppable growth machine. They are expecting an earnings per share growth of 60%, which is already massive, and they are forecasting a revenue growth rate of 100%, while this company is trading at a price to sales ratio of 2.7. Furthermore, our analyst is projecting a 25% to a 250% increase in the stock price. Then you might ask yourself, there must be something wrong. They must be in massive debt. Well, that's luckily not the case, because they have $170 million in cash that they can burn if they want to, and that's exactly what they're doing. They are not profitable yet, so that's the one negative point, but analysts are forecasting that early 2027 this company will become profitable, and then Wall Street will suddenly love this stock. And this company was previously only focused on being a space infrastructure supplier, but it's now transitioning into space defense, which opens a lot of contract opportunities with the government, and it's also becoming a biotech company, which is producing medicines for in space. Now, what's so bullish about this company is that with its recent acquisition, and now with Trump, who is very interested in space, especially now that they're in a kind of cold war with China, that will increase the demand from governments for advanced space defense systems. And all this positions this company to generate accelerating revenue growth. The next stock is another screaming buy, and it's called Neuronetics. You can basically tell from the name what this company is doing. It's improving the quality of life for people that are suffering from neuro health conditions, and this company growth rates are just dumb. They're expected to grow their revenues 130% and their EPS 50%. There are in total 3 analysts that are predicting that the stock price will surge between 100 and 150%, and the price to sales ratio is only 1.7. As you can see, this company is losing money, but luckily not some crazy numbers. And the Neurostar therapy is treating major depressive disorders and other mental health issues. And the addressable market will become larger every year, and this company provides more than 7.1 million treatments to over 2 million patients. If everything goes to plan, they're expected to be profitable very late 2026, but in the end this company is still very attractive, and they're solving a very big issue, which is depression. The next company is called MicroBot Medical. This company is generating 0 revenue, but next quarter this will change, and this will change dramatically to the point where they will make 14 million in the second quarter of 2026. But what is the focus of this company? Well, it's robotic and micro-robotic technologies for minimally invasive surgery. The funny thing is that right now you can't calculate the price to sales ratio because they aren't generating any money. So how would people evaluate the company right now? Well, you got to calculate the forward price to sales ratio, which is the market cap divided by the future earnings. So the market cap of this company is the public shares, which is basically 52 million, and you got to multiply that by the stock price, and then you will see that the market cap is around 140 million. Analysts are forecasting that the revenue of MicroBot next year will be 70 million. Then the 1 year forward price to sales ratio is 2, because 140 million divided by 70 million is 2, which is still extremely cheap. So this company is a must buy. The next stock is called AST Spacemobile, and this company will allow smartphones to directly connect to satellites. So just like you have Starlink with Tesla, where you have to buy a receiver, with AST Spacemobile, your smartphone will be immediately connected to the satellite and will give you internet at any time and any place. And they have strategic partners like Vodafone, Google, and other major companies. So this company basically makes satellites and launches them into space so people can get internet at any place. Now you guys obviously want to see the juicy stats. They're projected to grow their revenue 2000% plus, which is absolutely insane obviously. Their earnings per share 80%. Just look at the chart, and the big revenues are coming next quarter. Obviously the downside is the valuation with these growth rates. Their price to sales ratio right now is 2000, which is absolutely insane. But their 1 year forward price to sales ratio will be 100, and their 2 year forward price to sales ratio will be between 20 and 50. So yeah, they priced in basically 2 years of revenue growth. I'm not saying to own this stock right now, but definitely keep this stock on your radar, because if the stock price drops 10 to 20%, then it would be a very interesting entry into the stock. The next stock is called Syndax, and Syndax is a pharmaceutical company and already has 2 approved therapies, which one of them against bone cancer, which are starting to ramp up, and you can see that in the growth rates. As you can see over here, Syndax is not profitable yet. They're burning money, quite a lot also. But the positive thing is that they expect that their EPS will grow 30% and their revenues 300%. 13 analysts, which is quite a lot, think that this stock will go to at least $37, which is a 150% increase, and in bullish cases even a 280% increase, which is basically almost a 4x, and I fully agree on this. With a price to sales ratio of only 17, the valuation of this company is really not reflecting the growth rates. Just look at this chart over here of the revenues. This is basically a company company that is early in a multi-year growth curve. The other very bullish point is that this company is only providing this therapy in the US, so it has a ton of potential outside of US, like in Europe, in Australia, Canada, all that kind of stuff, to provide this therapy for people with bone cancer, and obviously to improve their revenues. And on top of that, they have a ton of financial firepower because they got 350 million from Royalty Pharma, so they can invest in their therapies, and so they are able to scale it up faster than they imagined. The next stock is a LiDAR technology company, and it's called INOVIZ Technologies. For the people that don't know what LiDAR is, it's used for real-time 3D imaging for autonomous systems, and they're making solid-state LiDAR sensors designed for mass productions, and they're making this hardware with AI-driven perception software that enables object detection, classification, and tracking. It's all super interesting what they're doing, but is it working in their business model? I can tell you one thing, it definitely is. So they are not profitable yet. They're trading at a price to sales ratio of 10. Analysts have a mixed opinion. On average, they think this stock will go up 20%, but there are some analysts that are more bullish than others. But this company is expected to grow their earnings per share 40% and their revenue 200%, which is absolutely insane, especially now that it's trading only with a price to sales ratio of 10. If we go over the earnings chart, you can see that the EPS is going the right direction, and yeah, the revenues are also just going up and to the right. This company is already selling its LiDAR systems to BMW, which is already in the market and is called the 7 series, if you want to search it up. And the new INOVIZ Smart line targets security, robotics, aerial and traffic intelligence, which is a huge opportunity for this company. And their biggest opportunity is with the Volkswagen robotaxis. That could absolutely be massive for this company, and it's forecasted that these robotaxis of Volkswagen will start their first commercial launch in the third quarter of 2026, so it's much sooner than expected and could 10x this company very fast. And this next company has one of the brightest futures ahead, with this year 100% revenue growth and the upcoming 3 years more than 50% plus revenue growth rate in the base case scenario. And this company is called AlvoTech, and this is a pharmacy company, and it's making multiple different drugs, some already commercialized and starting to ramp up like crazy in the United States, but also in Japan, Europe, Australia, all those countries, which are massive opportunities, and most of the drugs are still waiting for approvals. And you can see this in the bullish forecast of the analysts. The average price target is a 120% increase from current levels, and in bullish cases a 250% upside. And as you can see, this company is 2 quarters profitable, and looking at the PE ratio, it looks pretty expensive, but if you take in account that they have an EPS and earnings growth of 100% plus, the PE ratio doesn't look expensive anymore. You can see here the EPS forecast. It's going in the right direction, and same here with the revenues. They're ramping it up very fast, going from making $90 million this quarter to $200 million within a year. Now, if you watched until this point, please do me a favor and smash that like button. And if you wonder which stocks to own in your portfolio, make sure to watch this video, and I will see you guys over there. Bye bye.